Prabhudas, Lilladher are also with us to end the last 10 minutes of trade. Dilip, I'm going to start with you. This time, this quarter, we had good performances coming from the FMCG sector, whether it was Imami, Marico, Britannia, Godrej Consumers. Do you think that story has played out, or do you think that, post good numbers, it's still worth a buy?
Well, a very good question, because the valuations are always very challenging for all these FMCG companies. So it's always difficult to justify why you're recommending this particular stock. But purely from the performance angle, there are two things which really stands out very clearly. I think one point is that the raw material cost saving probably is kicking in a very big way. Second factor, of course, is that the overall volume growth has not been all that good, but expecting that gradually there is going to be some recovery in the economy. So probably that also will play its part on the volume growth. And I think overall, as and when the GST comes into play, we all know that it is the organized sector which is really going to make the most of it. So taking all that into account, despite their expensive valuations, these stocks will continue to attract investment, and for the right reasons.
Okay, so what do you do with a stock like Dish TV now? That one has, been seeing substantial gains. In fact, even today it's up almost 5%. Would you continue to back some of these media names?
No, not really. I think a large part is really played out. Maybe there is some steam still left in this. So maybe one can get some appreciation even from the current levels. But by and large, I think valuation-wise, I won't be very comfortable going forward for some of these companies.
So, Darshan, of banks, we've seen quite a bit of trading pop. A lot of this was because of valuations. But at current levels, are these still good bargains, or would you look elsewhere?
Couple of things that I'm banking on. One is that gradually, as they get an independent chairman, more like a quasi-private sector, independent persons. So I think that itself will bring about a good amount of re-rating and change in perception. That is one. Second, of course, as what we have seen, that RBI is also very much engaged in discussion with the banks and with the government about this 5/25 loans. So I think that also will ease some kind of pressure on the banks. And third, of course, that the government starts releasing the payment for some of its infra projects, which will ease the quality of the assets and the pressure on the banks. I think some of these things will play its role, and of course, on a longer term basis, the interest rate on a downward trajectory is what we are expecting. I think I'm expecting a little sooner than later. So taking all these factors into account and the valuations at which they are trading and the recapitalization the government is talking about, I think there's good steam left in PSU banks over next 1.5 to 2 years. I don't know what's going to happen over next 1 quarter or 2 quarters, because there could be some pressure on the NPLs. But slightly on a longer term basis, yes, I think on a risk return basis, they look good.
Okay, pull up one stock, Motherson Sumi. That stock has hit a fresh high today. It's up about 5%, and right now it's spiking up even in the dying moments of trade. This company reports its numbers tomorrow. It's been a great gainer. I mean, you don't need to talk about that. It's a well-discovered stock. But in tomorrow's earnings, the numbers are expected to be solid yet again. So 15% revenue growth, about 80% profit growth is what we're expecting, and an EBITDA growth of almost 24%. What do you do with this one, Dilip? Is there still more steam in this name, or has all the juice been out now?
Well, I think Motherson Sumi is very fast acquiring the status of being a stock which you should have as a part of your core portfolio. Because for the last 5 years, they very amply demonstrated that in spite of the acquisitions, in spite of the capex, they have been showing a reasonably very good CAGR on the top line, which is almost around 20%. But more important, despite all this, they have been keeping their ROEs, which is very widely tracked, much above 25%. So I think these two are very potent combinations. And I think with that kind of a track record, though the stock may look expensive at any point of time, but if you were to do a DCF for next couple of years, based on the growth, I think they will always look cheap. And this is something which, in spite of being a little
Sumit. That was one of the stocks to watch, by the way, in our top 10 list. But let's recap our closing rates. Just about one.
Comment in from you, Dilip, on these numbers. They have gone ahead and said that the Q3, okay, that is a non-GAAP EPS, but they've raised their full year EPS and revenue guidance. They've said that going ahead, the FY15 revenue will be up at least 20.1%. Seems like an optimistic view coming in from Cognizant to be at least $12.33 billion. So they've gone ahead and raised their full year EPS and revenue guidance. Dilip, you want to comment on, Cognizant raising its guidance, a lot of the IT companies like Infosys doing well this time around, and what your core portfolio should consist of from the IT space?
Well, as far as Cognizant is concerned, I think one thing is pretty sure that they have been slightly ahead of the pack, except for 1 or 2 quarters where they really lower the guidance. But I think they have been doing pretty well. But having said that, I think I'm not too sure whether they said it was in steady state currency or whether it was just an actual EPS which they have given the guidance. So that also needs to be seen. But by and large, I think the IT will still continue to look pretty good. And especially amidst this kind of an environment where I think the prices have really run ahead of the intrinsic value on expectations of future growth and performance, I think IT still stands out as one of the few, sectors where you can still expect that they are going to generate free cash. They're still going to generate returns in excess of 20%. And I think they have not really gone anywhere in the last 12 months or so. So I think Infosys, HCL, TCS probably will still be the one to chase in the front line.
Okay.